We're all looking for a safe place to put our money, but that search often leads to this classic dilemma. So today, we're going to break down a strategy that actually combines two of the most popular options to build a smarter, more flexible financial foundation.
It's the question that comes up over and over again, right? Do you go for the good old reliable fixed deposit, or do you choose the efficiency of a debt fund? It always feels like you have to pick a side. But what if I told you that's the wrong way to look at it? What if you don't actually have to choose? In fact, the most effective strategy isn't about picking one over the other at all. It's about using both together in a really smart way to get the best of both worlds.
So this whole debate really boils down to a fundamental choice every single investor has to make. Are you looking for absolute certainty, or do you need a bit more flexibility with your cash? Let's dig into that.
Okay, here it is, laid out plain and simple. A fixed deposit, or an FD, is all about certainty and stability. Think of it as the anchor for your portfolio. You lock in a rate and you know exactly what you're going to get back. A debt fund, on the other hand, is built for flexibility and efficiency. They really do play two very different roles.
That leads us to a really logical question. If FDs are so safe and predictable, why not just park all your money there and call it a day? I mean, it seems like the simplest, safest route, doesn't it?
Well, here's the catch. That safety comes at a price, and that price is your flexibility. FDs lock your money away for a set amount of time. If you need it early for some reason, you're going to get hit with penalties. This really limits your ability to deal with surprises and means your money just can't adapt when you need it to. And this is exactly where debt funds shine. They are designed for easy redemption, letting you get to your money when you need it. This is amazing for managing your cash flow, and best of all, you get to avoid those annoying early withdrawal penalties. So, here's a super simple way to think about it. Your fixed deposit is your core stability. It's that solid, unshakable foundation. Then, your debt fund is the flexible layer you build right on top of it, giving you the power to adapt to whatever life throws at you. Okay, so we get what they're for individually. Now let's get practical. How do we actually combine these two powerful tools so they work together? To make this super clear, let's just use a simple example. Imagine you've got 10 lakh rupees that you want to invest in some relatively low-risk options. Where do you even start? A great starting point, especially for a beginner, could be a simple split down the middle. For example, you might put 5 or 6 lakh into an FD for that core stability we talked about, and then the other 4 or 5 lakh into debt funds for flexibility. Now, this is just a guide. You can totally adjust it based on your own comfort level.
But we can get even smarter than just a simple split. A more advanced way to do this is to start allocating your money based on your specific financial goals and, crucially, when you're going to need that cash.
So, this goal-based approach changes the mix depending on your timeline. For short-term goals, say in the next 2 years, you'd probably lean heavily on FDs, but keep a little bit in highly liquid debt funds. For medium-term goals, a more even mix makes sense. But check out that last one, your emergency fund. Here, the strategy flips to favor debt funds almost completely. Let's talk about why.
This is such a key question. I mean, an emergency fund is all about safety, and FDs are safe. So why on earth wouldn't you just put the whole thing in an FD? Because the single most important thing about an emergency fund is getting to your money fast. Debt funds give you that quick access without penalties, which means you keep all your capital right when you need it most. An FD is way better for money you're pretty sure you won't need to touch unexpectedly.
All right, let's zoom out now and put this whole strategy into the bigger picture of your finances. There is a really simple, powerful framework we can use for this. Think of your entire portfolio in 3 simple layers. Layer 1 is safety. This is your foundation, and it's where FDs are absolutely perfect. Layer 2 is liquidity. This is your flexible cash, and that's handled brilliantly by debt funds. And only after those first 2 layers are solid should you build layer 3, growth, using things like equity funds for long-term wealth creation.
So, after all that, what's the one big idea you should walk away with?
It's this. Really good financial planning isn't about trying to guess the next hot stock or find some magical product. It's about building a solid, reliable structure that actually works for you and your goals. So, stop thinking about it as FD versus debt fund. Instead, start seeing them as 2 different tools in your toolkit. Use them both, but use them for the right job. FDs for stability and debt funds for liquidity. That's really the key to building a portfolio that's both stable and flexible. This conversation is for educational purposes only. Mutual fund investments are subject to market risks.
Please consult a qualified professional before investing.